Imagine buying like a massive $7 million commercial building, right?
Oh, wow. Yeah.
But fundamentally, you couldn't care less about the bricks or the roof or, the parking lot. You were buying it solely because of a signature on a piece of paper from a grocery store executive.
Right. It sounds wild, but it happens every day.
It really does. So, welcome everyone to today's deep dive. Today, we are cracking open a document that, to the untrained eye, just looks like, well, a standard list of properties for sale.
Just another real estate flyer.
Exactly. But it's actually a May 30th, 2026 email newsletter from the Eureka Business Group, or EBG. It's curated by their managing principal, Joseph Goslan. And we are looking at bricks, mortar, and dirt, primarily in the Dallas-Fort Worth area.
Yeah, and it's like looking at a topographical map, honestly.
How so?
Well, to most people, it's just squiggly lines and numbers, right? But to an investor, those lines show exactly where the water, or in this case, the capital, is going to flow. This newsletter, it isn't just selling buildings. It's selling entirely different flavors of financial risk. Market timing and return. It's really a menu of investment philosophies wrapped up in real estate listings.
I am so genuinely curious to get into this, because our mission today is to decode this list and uncover the hidden investment strategies. We're going to teach you how to basically read the matrix of commercial real estate.
I love that. The matrix of real estate.
Yeah. And EBG has been advising in the DFW market since, 2008?
Yep, 2008.
So they've navigated the Great Recession, the whole retail apocalypse thing, the e-commerce surge, and, all the recent interest rate volatility.
Mm-hmm.
And there's a motto right at the top of this newsletter that sets a very specific tone. It says, not every opportunity is the right opportunity.
Which is, that's the core truth of commercial real estate right there.
Yeah.
Absolutely. Buying property isn't about finding a universally, quote-unquote, good building. It's about finding the asset that perfectly matches your specific financial plumbing.
Okay, that makes sense.
Right. So to help you make sense of this, we're going to take EBG's curated list and just completely decode it. We can categorize these listings into 3 distinct investment strategies.
Okay, lay them on me.
We've got the safe bets, the value adds, and the creative wildcards.
Okay, let's unpack this, because I want to start with the most relatable concept, which is stability, the safe bets. Because if you are an investor who wants a completely hands-off approach...
You just want to sleep soundly at night.
Exactly. You don't want to worry about your capital depreciating. What does this list actually offer you?
Well, let's look at the top tier.
Yeah, in their $7 million and up bracket, EBG highlights this property in McKinney, Texas. It's 13,514 square feet, brand new 2026 construction.
Very shiny.
Very shiny. And the tenant is an institutional-grade grocer, specifically a Trader Joe's. Right. It comes with a 10-year corporate lease and CPI rent escalations, and it's sitting right in this affluent trade area. Buying one of these properties feels less like buying real estate and more like buying a blue-chip dividend stock. You're essentially just parking your money in a Trader Joe's, right?
You really are. And what's fascinating here is how they insulate you. In a macro environment where, labor and material costs can be incredibly volatile, locking in a lease with CPI rent escalations.
Right. Tying the rent to inflation.
Exactly. It isn't just a nice perk, it's a pure inflation hedge. Your yield is actively insulated from the unpredictability of the broader economy.
Wow. And we see another variation of this in Fort Worth, too. Also in that same $7 million plus bracket, there's this 19,708 square foot single-tenant medical facility.
Right, the ASC.
Yeah, an ambulatory surgery center operated by HCA Healthcare. It has 11 plus years left on the lease, annual increases, and this NNN, or triple net lease structure.
Right, the triple net.
And we see that same NNN structure, even down in the lower brackets, like the under $3 million bracket. There's an 8,000 square foot retail space in Bonham, Texas. It's an Aaron's store.
Yep, the rent-to-own place.
Exactly. It features a corporate tenant guarantee, a new 5-year lease renewal, and it's offered at a 7.00% cap rate. So again, you aren't underwriting the local real estate market in Bonham. You're underwriting the corporate balance sheet of Aaron's national headquarters.
I'd take it a step further, honestly. You're buying a corporate bond that also happens to carry the tax advantages of physical depreciation.
Okay, wait, break that down for me.
Sure. Let's look at why that triple net structure is so crucial here. In a NNN lease, the tenant is covering the taxes, the building insurance, and the maintenance.
So the landlord does nothing.
Basically nothing. If the HVAC system blows out at that Trader Joe's or, the parking lot needs repaving at the HCA medical facility, the property owner's yield doesn't take a hit. You're isolating your return from the operational friction of owning a physical building.
Oh, wow. Which makes that corporate guarantee on the errand store so vital.
Exactly.
Because even if that specific local store underperforms and just shuts its doors, the national corporate parent is legally obligated to keep cutting that rent check for the rest of the lease.
Precisely. And you know what's fascinating here is how these safe, low-friction assets perfectly align with another service EBG highlights in the newsletter.
Which is?
Their specialization in 1031-driven replacement needs.
Yes. The infamous 1031 exchange clock.
The ticking clock.
Right. For those of you who track the market, you know that if an investor sells a highly appreciated asset, they have this notoriously strict IRS-mandated 45-day window to identify a replacement property.
Or else
they get hit with a massive capital gains tax bill.
Right. And that ticking clock is really the invisible engine driving a lot of these safe bets. I mean, when you have $10 million in proceeds from a sale, you don't have the luxury of spending 2 years zoning and permitting a new development.
Right, you're out of time.
Exactly. You need to park that capital immediately. You need a newly built Trader Joe's with a 10-year lease. EBG even includes a 1031 exchange timeline calculator for their clients because managing those strict IRS deadlines is literally make or break.
That is so stressful.
It is. And sellers of these NNN properties, they know that 1031 buyers are highly motivated by tax avoidance, which is why these assets command premium pricing and lower cap rates. You are essentially paying for the certainty of placement.
Okay, so that is a phenomenal defensive play to protect wealth you've already built.
Absolutely.
But if NNN leases and corporate guarantees are the safe dividend play, what is the growth stock equivalent?
Now we're talking.
Right, which brings us to our second category, the value adds. So we are shifting from passive income to active improvement, finding the hidden upside.
And this is where an investor really has to roll up their sleeves and apply operational leverage.
Okay, give me an example.
Let's look at this exclusive off-market retail property EBG has in Addison, Texas. It's in the under $3 million bracket. It sits on Restaurant Row in a highly trafficked area. It has a great long-term tenant, but EDG specifically flags it as having a value add upside.
Meaning the property is undermonetized relative to its current market potential. You have to step in and basically force the appreciation.
That's the key term right there. Forced appreciation. You aren't just waiting for the surrounding market to get more expensive, you are actively changing the math of the building.
Okay, so how do you do that?
Well, the newsletter provides a textbook example of this in Moore, Oklahoma. This is in the $3 to $7 million bracket. It's a 49,100 square foot industrial flex space.
That's a big space.
Huge. And it's 100% leased, offered at an 8.70% cap rate, which notably is a significantly higher yield than that 7% safe bet we saw in Bonham.
Right.
But the strategic keys here are two phrases in the listing: below market rents and a 0.45 acre outparcel upside.
Okay, yeah, I noticed that more property includes this 0.45 acre outparcel. That feels like, I don't know, buying an oversized suit just so you can use the extra fabric to tailor a second pair of pants.
That's a great analogy.
Because you've got this leftover dirt, right? And you can spin it off to a Dutch Bros coffee kiosk or maybe a cell tower for an entirely separate revenue stream that just isn't currently priced into the asset.
That is the perfect way to look at it. It's hidden equity. By carving out that outparcel and establishing a ground lease, you effectively lower your cost basis on the main 49,000 square foot building.
That's brilliant.
It really is. But let's look at the other phrase, below market rents.
Right. Let's connect that to another listing in that same mid-tier bracket over in Roanoke, Texas.
Okay, yeah.
It's a 16,800 square foot industrial and flex space with fully built out AC offices and fenced outside storage. But the listing specifically highlights this. Short-term leases offer value-add or owner's user opportunity.
Yeah.
Now, I have to push back on this because usually institutional money craves weighted average lease term, right?
Generally, yes.
You want tenants locked in for a decade. So wait a minute. Aren't short-term leases terrifying? Doesn't that mean your tenants could just pack up and leave tomorrow? Why are we cheering for short-term leases here?
It's a really great question, and it highlights the trap of long-term leases during periods of high inflation.
Okay.
Imagine a landlord signed a 10-year lease with an industrial tenant, say, 5 years ago. Since then, the DFW area has just exploded, replacement costs have soared, and market rents for comparable flex spaces have effectively doubled.
Oh, wow. So they're stuck.
Exactly. That landlord is stuck collecting half of what the property is actually worth. The building is 100% full, but it's an economic prison.
Ah, I see. So as a new buyer coming in, you look at that and say, I am buying this based on its current low net operating income, but the second those short-term leases expire, I can mark to market.
Right, you bump it up.
If you bring rents up to the current baseline and the building is valued on multiple of its income, you've just instantly created millions of dollars in equity.
Precisely. And that is why the short-term leases in Roanoke are advertised as a massive benefit. You only have to wait maybe 12 or 18 months to completely reset the economics of the building.
Wow.
Or, as EBG points out, it's an owner-user opportunity. You buy it, wait a few months for the tenant's lease to expire, and then move your own operating business into the space.
So you're effectively paying rent to yourself and building equity.
Exactly. EBG advises heavily on, quote, market timing and pricing, and this is the mathematical reality of that advice. You are buying a timeline just as much as you're buying a building.
It really changes how you look at physical infrastructure. It's not just a static object. It's a living spreadsheet where the lease terms dictate the valuation.
That's a great way to phrase it.
So we've covered the safe bets, the defensive low-friction plays. We've covered the value adds where you can actively force the worth of the building up by resetting rents or carving out outparcels. Now let's move to the third category.
So wild cards.
Wild cards.
Yes, these are the listings that require true creative vision, or they exploit very unique financial and legal mechanics that usually scare off the average retail investors.
And here's where it gets really interesting. In the under $3 million bracket in McKinney, Texas, there's a 2,900 square foot medical office space currently operating as a gym.
Right, the gym.
Yeah, and it's actually 2 condo units that were merged. But the standout details are in bold text. EBG says it is selling well below county assessed value, and get this, owner financing is available.
Yep.
Now, I look at that and immediately think, what is the catch? Why on earth would someone intentionally sell a property below its assessed value and offer to finance it themselves?
Yeah.
And that sounds like a late-night TV infomercial.
It does. It sounds totally crazy. But if we connect this to the bigger picture of the current lending environment, it actually makes perfect rational sense.
Okay, now.
Well, traditional bank financing right now is incredibly tight. Interest rates are elevated, and commercial banks are highly scrutinized regarding their real estate exposure.
So getting a traditional loan for a, merged gym condo is going to be incredibly painful.
Or impossible for a lot of buyers.
Right.
Which is exactly where owner financing becomes a brilliant strategic tool. By acting as the bank, the seller massively opens up the pool of potential buyers. The seller gets to dictate the down payment and the interest rate, essentially creating their own private annuity backed by the real estate as collateral.
Oh, that's smart. But what about selling below the county assessed value?
Well, the county assessment is just a lagging indicator on a government spreadsheet. The real value is what provides liquidity today. If the seller has their own 1031 exchange timeline to meet, or, maybe they are liquidating a partnership, speed and certainty of close are far more valuable than squeezing out the last 5% of the purchase price.
It's a classic arbitrage of time versus money.
Exactly.
You are getting a discount because you are providing the seller with an immediate exit. Okay, that makes sense. Now let's look at the literal dirt, the raw land plays.
Oh, these are fun.
Yeah. Also in McKinney, in the 3 to 7 million bracket, EBG has 6.09 acres of commercial land flagged as back on the market.
In all caps.
In all caps. It has Highway 380 frontage, exposure to 44,432 vehicles per day, and it's near an airport expansion. But the magic words for me are no zoning restrictions.
Yeah. No zoning restrictions is the ultimate blank canvas in commercial real estate. When you buy a building, its highest and best use is heavily dictated by the municipal government, right?
Sure.
The zoning board tells you if you can build retail or industrial or multifamily, but unzoned land, especially sitting on a major highway corridor near an expanding infrastructure hub like an airport, your optionality is staggeringly open.
So you aren't fighting City Hall for a variance to build a logistics facility. Mm-hmm. The value is entirely limited by the developer's imagination and, their ability to execute.
Right. And contract that with another creative land play we see in Cedar Hill, Texas.
Okay.
It's 37.8 acres of residential land. It's a CASD asset sale, so the local school district is liquidating surplus land.
What interesting.
Yeah, and it's being sold via a sealed bid opportunity. And EBG explicitly notes zoned res, BTR possible.
Ah, BTR, meaning build to rent.
Yes.
Building entire cohesive neighborhoods of single-family homes that are purpose-built to operate as a single rental community rather than individually selling them off to homeowners.
It is a massive institutional trend right now. But let's look at that sealed bid mechanic.
Right, because that's tricky.
Very. This isn't an open auction where you can just outbid the next guy by $1,000. It's a high-stakes underwriting exercise. As a developer, you have to project the cost of laying roads, trenching utilities, vertical construction for dozens of homes, and project the rental yield years into the future.
All while totally blind to your competitors' bids.
Exactly.
So you have to perfectly thread the needle of offering enough to win the dirt without falling victim to the winner's curse, where you overpaid and destroyed your yield before you even poured the first foundation.
Exactly. It requires an incredibly sophisticated underwriting team. And just to round out these wild cards, look at the Arlington, Texas listing.
Okay, yeah, under $3 million bracket.
Right. A 32,925 square foot building entirely leased by the state of Texas Health and Human Services. It boasts an AAA credit rating, an 8.25% cap rate, and CPI-based rent increases.
Now, wait a minute. A state government isn't going to bounce a rent check.
No, they are not.
That sounds like it belongs in the safe bets category with Trader Joe's. Why is it a wild card?
Because the market prices risk differently when dealing with a bureaucratic entity.
How so?
Well, a government tenant operates under a completely different paradigm than a commercial business. The friction involved in lease renewals, the specific rigorous security protocols, or, specialized ADA compliance requirements for a state health facility.
Ah, the red tape.
Heavy red tape. It requires a landlord who knows how to navigate that. You are getting a phenomenal 8.25% yield precisely because the market is pricing in the headache of government bureaucracy. It requires a highly specialized management approach to protect that yield.
So what does this all mean?
Yeah.
We started by looking at a standard email newsletter that, at a glance, just seemed to be a list of addresses, square footage, and price brackets.
Right, just squiggly lines on a map.
Exactly.
Right.
But by decoding the mechanics behind it, we've seen that it's actually a menu of highly sophisticated financial instruments.
Absolutely.
Whether you're an investor utilizing a 1031 exchange to secure the inflation-hedged passive income of a Trader Joe's, or you want the active challenge of forcing appreciation by resetting rents in a Roanoke flex space, or you're underwriting a blind bid for 38 acres of build-to-rent dirt, EBG's curated list proves that commercial real estate requires an incredible understanding of macroeconomics, lease structures, and really human behavior.
It really does. And, I want to leave you with one final thought to ponder about the macro landscape here.
Yeah.
Look at the specific property types that EBG curated as the best value for May 2026. What do we actually see?
Let's see.
We see ambulatory surgery centers. We see kidney care facilities and merged unit gyms. We see quick service restaurants. We see flex industrial spaces for warehousing. And we see state government health offices.
It's a very specific utilitarian cross-section of everyday life.
It is. Commercial real estate is ultimately just a physical reflection of human behavior. Capital inevitably flows to where human demand is the most resilient.
Wow.
So if this curated list represents where the smart money is moving right now, what does that tell us about the trajectory of our society? Are we moving toward a landscape where the only physical footprints that truly matter, the only buildings that reliably command institutional wealth, are the places where we get our health care, where we grab our quick food, and the industrial distribution centers that process our e-commerce deliveries?
Wow. That is a profound way to look at a strip mall.
It's all connected.
It really forces you to view the built environment through an entirely different lens. So next time you drive past a retail center or a fenced-in warehouse or a massive unzoned lot sitting on the highway, keep your eyes open. You weren't just looking at buildings. You were looking at a real-time matrix of risk, reward, and the physical footprint of the modern economy. Thank you for joining us on this deep dive. Keep decoding the world around you.